Welcome back. President Trump is shaking up the housing market with his newest plan, considering 50-year mortgages for homebuyers.
The head of the Federal Housing Finance Agency, Bill Pulte, says the plan is already in motion, calling it, quote, a complete game changer.
Let's break down what this would mean. Right now, a 30-year fixed mortgage on a $400,000 home averages a payment of about $2,038 a month in principal and interest. Stretch that loan to 50 years and you'd pay $1,822 a month, a savings of just over $200 a month. So joining us now, the Ramsey Show co-host, Ken Coleman. It's great to have you. I want to get your take on this because while the payment came down in that calculation, because you are spreading this loan to 50 years and not 30, it's an extra 20 years of interest you're paying on it as well.
This is a horrible idea. The last thing Americans need is more debt. We just saw on the news today that we've now reached another record high for household debt. And all this is more debt. You just laid it out beautifully. We're now going to see, I think, in the next 6 months, if we haven't already gotten there, that the average age of a first-time home buyer in America is going to be 40 or older. So let's run this out. You're going to be 90 years of age before you pay off this loan. You're going to die with this debt. You're going to pass this debt on to your kids. All for what? Barely $200 a month in savings. I'm shocked that this is coming out of a Republican White House and the Trump White House. Mr. Pulte knows way better than this. A game changer? Let me tell you who this changes the game for. Banks. Banks love this. Yeah. This is a horrible idea. It's ludicrous.
All right, Ken. Well, I'm obligated to give the other side of the argument, right? Because we're talking about money here. At the end of the day, sure, it does save $200 a month, and that's not really enough. But when you look at a $400,000 home and what the potential rent could be on that $400,000 home, the question is, would it be $2,000 a month? And if the rent is $2,000 a month and the mortgage is $2,000 a month, why are you not in favor under that premise?
Because it's debt. I don't care how you play those numbers right there. Yeah. Debt is debt. And I have flexibility when I'm renting. See, I'm sitting in this studio where we take calls every day with people that are struggling with debt. Yeah. And they get too much house payment, and then they feel stuck. And many times they are stuck because they're upside down in a home. You're not having that with renting. So, no, I don't like that comparison. Debt is bad.
Well, Ken, let me make the comparison a different way. The debt balance that you start your 30-year mortgage with and your 50-year mortgage with are exactly the same. So it's not more debt. It's more interest expense over the term of the loan. But the principal balance doesn't change. So how is it more debt?
Because you're paying all that interest front-loaded. You know that. And the average home buyer is selling their home somewhere around 11 and a half years. Check me on that, but it's pretty close. Yep. And so you're going to have little to no equity at that point. And so I think we're playing semantics, to be honest with you, because that interest, you owe that interest, and it is more interest. If you look at the numbers out there on a $400,000 house, you're looking at several $100,000 more that you're going to have to pay in interest. So that is more debt. And so, again, I don't know why we would propose this idea for a mere $200 a month.
Savings a month.
Debt is debt, and debt's bad. And $200 a month, by the way, in today's economy is not going to make that much difference to people who are already burdened with credit card debt, car payments, and the like. Student loans, really not. I could keep going.
We made the argument on the Big Money Show earlier today that prices are too high, and that's the real issue. Prices need to come down, whether it's increasing supply or other avenues, reducing regulation to make that happen.